The probability of startup failure significantly outweighs the chances of success. So, why do VCs prioritize growth so heavily? And how do their incentives, both their own and those of their limited partners, differ from those of the founders?
You take venture capital, you're basically signing up for the hyper growth incentives and expectations that VCs have from founders. And there's some things that as a founder you need to be aware of when you're dealing with VCs. VCs are not your best friend. They are portfolio managers. They're not company builders. Their job is to raise money from limited partners or LPs, like a big pension fund or a university endowment. And their job is to raise money from these LPs, and they're expected to double or triple that LP's investment in their venture fund over 10 years. So that pressure is what sets up the VC's own incentives, and that's sort of what guides the VC's relationship to you as a founder. So it's not inherently bad. It's what the VC model is designed for. Most VCs, they're required to be focused on those companies that have the highest earning potential, like the billion-dollar companies. But from a founder's perspective, if you're building a great business that can be worth $10 million or even $50 million, that's not a big win for the VC, because the VC is going to lose most of the investments they do in the other companies. So they really need you to be a billion-dollar company for their 10 or 20% stake to make up for all the failed investments they do in other companies. So this is a really important caveat to understand between the difference of venture capital incentives and the founder's incentives. A founder might be very happy with a $20 million company. A VC for sure is not. And the VC's incentives are tied to finding one or two mega winners, not in helping every founder succeed or helping every founder in their portfolio build a solid, profitable business. If there's a portfolio of 20 companies, the VC only needs one or two to be unicorns to make their entire fund look good and make their money back and make a return for their investors, which is the LPs. The rest of the companies, they're just collateral damage from the VC's perspective. And when you take money from a VC, you're also tied up to burn cash fast for faster growth, because VCs want you to grow your company fast, so that they can go to their LPs and say, hey, all my companies are now growing really fast. Give me more money for my second fund. And so that's a bit about how the VCs are structured and incentivized to push for faster growth, so that of the 20 companies in their portfolio, one or two become a unicorn, and the others, if they die trying, that's pretty okay from a VC's perspective, but that might not necessarily be the same case if you're one of those 18 other founders who are not going to be a unicorn, but maybe you could have had a 20 million or $50 million good business. The VCs aren't just going to guide you in that direction, and it's really important for you to be aware of that.